discussed about the antitrust, but then my question is, and I've read, a few news and a few pieces of information research where it seems like, there is more concerns around, for example, the ESG impact and the reputation that certain deals have. They might not happen just because there is an ESG implication. At the same time, if we look at defense-driven industries, there is a whole concern about the national security. So let's say if you are, even from a data perspective, really think about it, right? There is for cross-national and cross-border type of deals, there is a whole other consideration to do in terms of, okay, is this deal actually going to hurt the flow of data and information for the company's merge? So I guess, do you see a lot of these for real, or you think it's kind of a sense, but it's not really happening, and maybe there is more focus on actually making money rather than thinking of too much consequences, if that makes sense.
Yeah. So when you talk about those kind of categories, we in the risk management, we kindly label that into sensitivity versus relativity of that deal, basically, because there will be, if you talk about if you talk about relativity, definitely there is a continuity angle, even though you want an ambitious return, but their operational challenges would be something else from a portfolio company or a fund standpoint. So looking at what's the relativity, that's where the macro comes into play, is where you assess all the different types of risks, market risk, credit risk, and all those different risks for the portfolio company. And you also do that risk management at a fund level. Now, when it comes to investor obligations, getting them dividend and making sure that you always have that operating income going on. If there is another COVID, there is no operating income. So you need to liquidate the asset and then pay back the investor. So that is where you define sensitivity versus relativity. And sensitivity is more around those linkages of deep economic integration. For example, uh, the real challenge between tariff between US and Canada, that is a sensitivity because it has to be followed up with a particular continuity factor and a transition factor. Yes, US has that ambitious energy plan and all of that, and those plans do require a certain continuity and transition indicators to build that reserve together, and then you have negotiations on the tariff and stuff. So that's what private equity does. It's not only creates the value for the investor, but at the same time it also creates that private market, capital market building through investment infusion into the companies, is where is you build that sustainable chain. So that's the key, is where how you understand sensitivity versus relativity of the portfolio. And it could be a single portfolio company, or it could be a full portfolio company, as you are into a co-investor or direct investment, whatever the type is. You enter into a fund, it will have certain value, and that certain value will have a series of risks coming into play.
I wanna, and there, like, okay, this is not really prepared per se as a question or as a thought, but because I'm receiving with the help of our LPGP staff and colleagues, I'm receiving some kind of summaries of questions that we are receiving live into the event. There is one of our participants that has been quite active, Tom's Jensen. So thank you very much. I see all of you are sharing thoughts. But Tom's asked actually I think he's making a good point. And I just want to read you what he's saying, and then we can comment on that. Which is, speaking of the Apollo global takeover, yes, it's a big number, but scale doesn't always equal substance. Switching between equity and credit might service the financial model, and from an investor lens, it can look efficient. But I find myself wondering, where in that motion is the care for what the number holds, for the people, the systems, the stories behind the valuation? I think this is a very good kind of point. It's kind of a question, but also making a point. And I do agree, other than the ESG, regulatory risk, all the stuff that come from the playbooks. Like, what about the people? What about the, humans involved? What about the story of the company? Is this risk, in your opinion, factored in? Because it does represent also risk, right? Cultural risk.
Yeah, and coming to that, Apollo itself, if you look at their portfolio, the reason why they do sensitivity relativity of the underlying products itself of the funds. It could be equity, credit, debt, derivative. Credit gives you a solid return, basically, because you have a very well repayment structure for a credit fund, and credit and insurance funds are the ones who drive actually very focused valuations basically. So you know when that dividend is going to come, you know when the return, what kind of return you can expect. So basically you get ratios, you get good ratios there, you get ranges, and you also get uh, the alignment with the markets as well when it's credit. Because when you look at a credit fund or an insurance fund, the first thing that you look at is correlation versus non-correlation from an economic alignment standpoint. And that's what gives you, hey, I could expect on a one quarter the return or the operating income is less, or it's going to be more based on those macro effects. But when it comes to equity, you just go into a series of uh, valuations. It's all based on how your net asset value works. So that is where I think Apollo's has got a very good return. So as ARC investment, it went to more than what, 130 or 140% a couple of years ago on return. So even that, the major factor was a product diversification, because ARK investment ended up building diversified ETF products in the market, which is a combination of both, the mutual funds and the hedge fund. That's the activity that goes into play. So it's all based on the product type, equity, debt, credit, derivative, and it also based on what fund you're getting into. Because if you go from a hedge fund standpoint, the cycle of a hedge fund is less than a year or two, or max of 3 years. But if you look at a private equity, it goes anywhere between 7 to 15 years, which is the largest patient fund. So that is how you look at and you structure those portfolios for your investors, based on that risk and based on that journey of the investor relations. Because every time there is a change, whether it's a clawback, whether it's a whether it's a drawdown, or whatever the other things that are in the term sheet, requires an extreme side letters, right? So that is where the legal comes into play. And I had an interesting session with one of the largest investment management company. They said we need a data model for each investor. It's not about that each deal, how the investor would like to accelerate their involvement through co-investments, direct investments, or whatever the other. Because if it's a pension fund, they come with their set of requirements as well. So to manage their requirements, there's so much data coming in, and there's so much in return that they need to maintain the accountability, transparency, and compliance, and regulatory aligned to those regulatory challenges as well, which is managing with the investment regulatories or monetary regulatories. So that is where maintaining that transparency and accountability. There are more systems coming into play. The data is now being very consistent and helping the funds to make those decisions.
Vinay, thank you very much. It was very insightful.